In the Money is made possible by financial support from Old National Bank and Chicagoans like you. Thank you.
Good evening, Chicago, and welcome to In the Money. I'm your host, Tamara Durbin. Benjamin Franklin once said, an investment in knowledge pays the best interest. And when it comes to wealth building, nothing will pay off more than educating yourself. The truth is, if you want to grow your money, you have to invest. But the real question is, how? Some say the stock market is the ultimate wealth building tool, while others swear by real estate. So which one is right for you? Or could both be part of your strategy? Tonight, we're breaking it down in Investing Your Way, stock market versus real estate. We'll explore the risk, rewards, and what it takes to succeed in both. Whether you're working with a little or a lot, this episode is packed with insights to help you make informed decisions. After the break, I'll be joined by wealth advisor Charles Clemens, who will help us understand both strategies and how to determine the best fit for your financial goals. But before we dive in, a quick note. Tonight's discussion is for educational purposes only and is not intended as professional financial advice. Stay with us.
Hi, I'm Robin Robinson. This week in other news, I'll sit in conversation and community with former Cook County State's Attorney Kim Foxx. We'll talk about her legacy, the many highs and lows from her time in office, and what you need to know about holding those currently in office accountable. Kim Foxx, in her own words. Join the conversation on CAN-TV Cable Channel 19 or stream live on cantv.org or on the CAN-TV Plus app. Hyperlocal news and critical analysis. Experience the power of community television.
Welcome back. My first guest is Charles Clemens, wealth advisor for Lexus Wealth Management. Welcome to In the Money, Charles.
Well, thank you for having me.
I appreciate you being on the show today to share your expertise with our viewers. And of course, we're talking about investing your way, stock market versus real estate. So my first question for you is, for someone completely new to investing, how would you compare investing in the stock market versus real estate, and how do you typically consult your clients when they're trying to decide which route to go?
Well, let me first say that directly investing in real estate is not something that I have done at a marketable level, if you will. My expertise lies almost solely in the equity markets. Okay. So, I'll preface it by saying that. Okay. But what I can say is that when it comes to investing, I think the easiest way to go about this thing is going to be simply access to the market, whatever it might be. Mm-hmm. How easily can I access whatever vehicle that I'm looking for that might help me grow? I would argue that it might be easier to do that in the stock market simply because a share of a stock is probably far easier to acquire than, say, a 3-flat building to invest in or something like that. So that's probably the delineating factor for most people. How easily can I get in? How can I make a mark and do the things that I want to do as easily as possible, quite frankly?
What are the key risks and rewards for each investment type, and how can someone determine their own risk tolerance to decide which strategy, real estate, stocks, or both, sure, is best for them? Because people don't really think about what their tolerance for risk is, and when they
sure,
look at different investment options.
Sure. Well, within the equity side of things, there are different parts that offer different levels of risk. I mean, there are your blue chip types of stocks, your Apples, your IBMs of the world, and Microsofts. Those are going to be a little bit less of a bumpy ride because those are, again, these are mega cap companies. They don't move as aggressively as some others, but you can, in fact, have small cap companies, that will move very aggressively as the market moves. And so even within that sector of things, you have to watch, your own risk tolerance. Figuring out your risk tolerance is not that difficult.
Okay.
We have questionnaires. Every advisory firm has a questionnaire that a client can sit and go through, and after answering said questions can figure out, okay, am I aggressive? Am I balanced? Am I conservative? Frankly speaking, most people are balanced. I've had a few people think they're very aggressive until they read the questions. How much risk are you, how much are you willing to lose?
Right.
That's always the one that stops everybody.
Right.
So,
and then also,
yeah.
because people, I feel like they don't think about risk tolerance until markets start to shift, and markets are always going to be shifting.
Yeah.
And are you going to be jittery when the market moves? And can you hold versus them calling you saying, sell it all?
Yeah, absolutely. And there, to mitigate that, we do have certain markers in place. If a client says, okay, well, I'm comfortable with a 20-point move. Well, a 20% move rather. If the market moves at 20%, we can sell your position and go to cash if that's what you want. I wouldn't necessarily recommend that we do that across the board, but there are instances where if there is a real fear that a loss might be coming, we can manage that. When you're talking about real estate, managing risk is very different because now you're talking about something that you own already. The risks inherent to real estate are certainly very different. You're talking about tenancy, the market, and the economy, how it moves, and it affects people who pay rent.
Yeah.
So those are the things that have to be well thought before going into real estate. And again, is it a important part of a portfolio? Absolutely. The return, I think, is what people are mostly interested in, and that's what I think drives the directly held real estate route.
You kind of touched on a little bit. How do economic trends typically, whether it's interest rates, of course, we know about inflation, market cycles, how do they impact both the stock and the real estate investment markets?
Sure. Certainly, interest rates are going to affect real estate. At what rate will I acquire a property? And then that's going to tell me, what the debt service is going to be on the loan that I get to acquire the property, which is probably going to drive to some degree what I charge for rent. So that cycle certainly has a very direct impact on real estate investing. Frankly, in the equity markets, it's almost as impactful. I don't think people see it the same because when interest rates go up, the cost to borrow money goes up for corporations. And when that happens, and things get a little tight, as they say. And, we start to see things like layoffs, and we just went through this.
Yeah.
We had a really, really nasty cycle after 23. Market cycles play a huge part in investing in general, and how it's applicable to each side can vary, but it will be felt.
We know stocks can be bought and sold quickly, while real estate is something that's more of a long-term commitment.
Sure.
How should that impact someone's investment decision in either market?
Yeah, well, I think that speaks to risk tolerance. If you can, I'll say it, very, I guess the faster you can touch the money, the less you're going to earn on the money.
That's good.
Yeah. So if it's a checking account, a savings account, or something like that, what are the rates that they're giving you? Not much. And if I can go to the ATM and get the money, I'm probably not going to earn much from it. So to that end, real estate investing it's a longer hold. I would expect there to be a little bit more risk involved in doing that. But I mean, that risk is calculated up front. Most people who invest in real estate understand it. The game is a little bit longer, and for that, the reward is a bit better. So there's a bit of a balancing act between those two things.
Between stocks and real estate, which strategy, and you kind of maybe answer this, which strategy typically builds wealth more consistently over time and why?
Oh, that's a loaded question. So again, I think it's access that's going to drive that. We can argue that real estate has probably been the single most impactful part of the market that we've seen in this country, at least. You know, we've got a definition of it. You know, in terms of how it impacts us. I mean, it really is the absolute, you know, fundamental ground floor of everything we know in terms of building this country. It was all built on land acquisition in some way, shape, or form.
Right.
You know, we can argue the methodology, but that's really what it was about. The stock market, I think, is a great complement. You know, even as an advisor, I mean, we have clients who own both, and there's nothing that there's no way I would tell a client, hey, don't own that, own this instead. The question becomes, how can you own it all and it benefit you in a way that's conducive to your success? And my answer simply would be, it's easier to get into the market than it is to buy a property. And I'll leave it at that.
All right. Okay, we're going to leave it at that.
Okay.
After a quick break, we'll be joined by investors Dion Smith and E.J. Williams to continue the conversation. In the Money continues on the other side of a short break. Stay with us.
I'm Andy Zopp, the host of Chicago Newsroom 2.0. Every week, we gather for insightful conversations with local journalists and community leaders as we discuss the news of the day and how it impacts the lives of Chicagoans. Join the conversation on CAN-TV Cable Channel 19 or stream live on cantv.org or on the CAN-TV Plus app. Hyperlocal news and critical analysis. Experience the power of community television.
Joining the conversation are stock market investor Dion Smith and real estate investor E.J. Williams. Welcome to In the Money, Dion and
Thank
E.J.
you.
Well,
Thank you for
E.J.,
having
it's
me.
your second time technically because we filmed you in the field, but
Yes. Thank you
welcome
for having me
to the
back.
studio. Welcome to the studio. So we're going to start, continue our conversation about investing your way, real estate versus the stock market. And Dion, we're going to start with you. What inspired you to start investing in the stock market, and what was your first investment?
Okay, what inspired me was my grandmother. She worked at Illinois Bell, which is now AT&T. In 1984, the government made Illinois Bell break up because it was a monopoly. And so as an 8th grade graduation present in 1984, she gave me 10 shares of AT&T stock, which I still hold today.
Wow.
She gave me 10 shares, it was $30 a piece at the time, so like $300. So I'm 13 years old, my grandmother gave me this stock certificate. I actually had the certificate. And she said, hey, this is a gift to you, and started explaining it to me. And my father then took me under his wing, and he would read the Wall Street Journal every day. So he would make me read the Wall Street Journal, and he would tell me, this is how rich people communicate with each other before the internet we have now.
For someone looking to invest, but right now they're feeling overwhelmed, where would you recommend they begin?
Before I give you any financial suggestions or advice about investing in any way, shape, or form, I ask you for your budget, and you'll be surprised that most people don't have a budget. Have a written budget so you can see what money you have now and where it's going. See all of your expenditures, see what disposable income you have, and then we'll start from there. So for example, say you have $100 a month and you're just beginning. I would break that up into 3 segments: a short-term savings account, a long-term savings account, and an investment account, with $30 going into the short-term, $30 into the long-term, and then the rest, the $40 into an investment account. And then I would break up the $40 into 25 and 15.
So some people day trade, so we're talking about kind of like the investment types that people do, while others invest long term. What is your personal strategy, and why do you feel that works for you?
We're going back to when my grandmother gave me the Illinois Bell, not AT&T shares. I still have them after 40 years. I'm a long-term investor.
Okay.
And my position is to leave wealth to my children's children. So I don't want to keep or spend the money. I want to pass it along for another generation and another generation and another generation. So I'm a long-term investor. Although I do some quick stuff
Okay, no, that's good.
when I see opportunities. Sure.
Okay, so now let's talk about passive versus active investing. We look at like the index funds, ETFs, individual stocks. What's your preferred approach, and what do you recommend for beginners? And what would be more passive versus active?
For beginners, I would start with something like the S&P Dividend Fund. The S&P is the S&P 500. It's the largest 500 companies like Walmart, Amazon, Coca-Cola, Nike, things that we often use, we know and we're familiar with, are comprised of those 500 companies. But I like the special index that has the dividend component because you would get dividends every 3 months, or what's called quarterly, which will pay you because it may not generate high returns, but you get the dividends every month, and then you reinvest those dividends, and your money starts to grow.
All right. Now, EJ, we're going to talk a little bit about real estate.
Okay.
Okay, so what drew you to real estate investing, and what was your first deal like, if you can remember?
Oh, yeah. I think everyone should remember their first deal. But luckily for me, it was really successful. My first deal was actually a flip on the south side of Chicago. And I was just inspired, honestly, from watching television, watching flipping shows. I always had a knack for real estate. I always was interested in real estate. I had a knack for design. And I was literally at home watching the show, and I said, I think I would like to flip a house. Literally, that's where it started.
Just watching the show?
Yes, and then I had friends that were flipping who were their brothers and their school teachers, and I'm like, if they have the flexibility to do it, let me talk to them. I talked with them. They gave me their contractor. And then went into, it was in the greater Grand Crofton neighborhood. So that was my first flip, my first project.
Okay, so let's get, in brass tacks. So we kind of know, like in the stock market, there are avenues to start small. So can someone invest in real estate without a lot of money, and what are some creative ways to start?
Yes, absolutely. There's so many different ways that you can invest in real estate. Obviously the popular ones that people hear about is flipping or maybe wholesaling. But wholesale in particular is most times the entry-level way into investing. So it doesn't take much money to do that. You can also invest in a real estate investment trust as well. So in that way, you can grow your money that way. It's not as risky as going into a full-fledged flip without experience. You can be the bank. You can finance projects. So sometimes projects need cash infusion, or sometimes there's crowdfunding for specific projects like buying commercial properties or apartment complexes. So those are ways that you can get into those projects. It's a little bit more passively, but you can put your money to work.
Okay. Some investors buy and hold rental properties while others flip. We kind of talked about flip. Which strategy of all the ones that you do, which one do you prefer and why?
There is not one that I prefer. For me, I'm skilled at both, but I would say for someone else, you need to figure out what your risk tolerance is, what your resources are, and then figure out what would be best for you.
Okay. Now let's kind of talk about passive. So people always feel that real estate it can be very involved, all right? So can real estate truly provide passive income, or is it more work than people really expect?
One, I think sometimes just in general, people underestimates what it takes to do anything.
Because they see the shows on like HGTV, and it seems like, they go get the property, boom, in 6 months, there's a new project. But go ahead.
Yeah, and that has really misled a lot of people in that regard. But as far as the passive way, is buying and holding. That is what most people probably will be comfortable at, meaning you can buy a 2 or 3 unit building, and that's not something that you're involved with every day. Once you get tenants in it, you do need people to maintain it, but if that begins to be too much, you can hire a property manager. And that means you can just collect your rent every month. Your tenants may not even know what your name is, right? They're just dealing with the property manager. So that's a passive, typically a little bit less stressful way of,
to do it.
Yeah, but you have to make sure you have the right team and the right property manager in place to do that.
Okay, so this is our last question, and this is kind of rapid fire, okay? And I'm gonna start with Dion.
Okay.
If someone could only pick one investment path, stocks or real estate, what would you say to convince them to choose the stock market?
Okay, now listen very carefully. I would choose the stock, but I would choose a stock that's a REIT, Real Estate Investment Trust.
All right. Okay, EJ?
Of course, I have to swing with real estate, right? And then passively investing in real estate is a way that you can build wealth long term. It's a tangible asset. You can leverage against it. It's a lot of ways that you can make it work for you.
All right. And Chuck, what about you?
I would like to go back to something that Dion said earlier, and it is about familiarity. I would choose the stock market because I could participate in the growth of companies that I probably use every day. That's what I do.
That's good. Well, thank you to Dion, EJ, and Charles for being on the show today. I really appreciate it. I know that our viewers will be really educated and also inspired to if they don't know about the various markets, they will engage to learn and also actually start. So thank you for being on
Thank
the
you for
show
having me.
today.
Thank you
for having me.
On the other side of the break, our in-house financial education expert, Ben Juergens, returns live in studio with an all-new Money Matters. Stay with us.
Every community has a story, a pulse, a voice waiting to be heard. At CAN TV, we bring these stories to life, from the heart of Chicago to your living room. Join us in supporting hyper-local television. Your backing helps us cover what matters directly in our communities, unfiltered and upfront. Help tell the important stories of our communities. Become a program underwriter today.
Joining me now for this week's Money Matters is Old National Bank's Director of Financial Empowerment, Ben Juergens. Welcome back, Ben.
Thanks, Tamara. It's good to be back.
So I want to continue our conversation of investing your way, stock market versus real estate. And I wanted to talk to you more about people really understanding the investing side of our conversation. So a lot of people think that there are a lot of barriers to investing. They think they need a lot of money to start to invest. What are some realistic ways someone with a limited budget can begin building wealth through the stock market or real estate?
Yeah, I think it's having your finances in order and having a plan is huge, right? And there is that misconception that you need, $100,000 to go see an advisor, and you don't. And talking with a lot of our advisors, they love working with young individuals. So just having a budget, as I know it was talked about earlier, and having a designated amount of your free cash flow that you can just automatically put into that investment fund. While it may seem small or trivial at the beginning, it adds up over time, as we've seen in other discussions about finances. But that or even real estate, it's two options that if you can settle aside steady income or steady money going to these types of investments, it really pays off in the long term because the time value of money is huge. And when kids understand that, it's a big thing.
How can someone leverage banking tools like a savings account, credit, or loans to position themselves for a successful investing in stocks or real estate?
Yeah, so emergency funds we've talked about over and over, right? So I think you got to have that first. I'm not a fan of investing in the market if I don't have my emergency cash built up. And because that's what you need in an emergency. You don't want to hopefully get rich off the stock market and that becomes your fund, right?
Right.
So once you've got that taken place, then I say that's where you really want to look at investing, because if your emergencies are taken care of and your needs are taken care of, you want to earn more than your traditional bank account, right? Don't tell the bank I work at. I said that, but you want to earn more than that, right? And that's where a market investment fund can do that. And I think if you're going to look at real estate, you've got to have the good credit. So if you do need to borrow money to buy that first property, you can do it at a less expensive rate. And then once you get that going, you can use equity within those. So you don't need to keep borrowing money for those additional properties. You can kind of roll it into that. And that's where your bank can really help you in understanding the right strategy for you.
Right, that's the key, understanding what your particular personal strategy is. Let's kind of talk about mindset as it relates to this. Some people hesitate to invest because they have a fear, and we understand a fear of losing money, right? How can someone shift their mindset from seeing investing as a risk, which we know there is some risk inherent, to viewing it as a long-term wealth building strategy?
Well, number one, I never look at my portfolio if the market's down. That's one thing.
Tell the people.
Yeah, because it's emotional. You've got to keep your emotions out of your long-term goals, right? So my recommendation is when you're looking at investments, don't look at it unless the market's up. If it's down, you're going to get emotional. But try to keep that out of it. But at the same time, having a good strategy, but diversifying your portfolio. What we mean by that is some high risk, some low risk, some medium risk. You don't want to throw all your eggs in one basket, right? I'm not putting everything in crypto or something like that, right? So I think that helps alleviate the fear that could be out there if you know that you're protected. But trusting the advice of a financial advisor that understands you and understands your goals, so they're not pushing you into things that you don't feel comfortable with as well.
Thanks, Ben. On the other side of the break, we'll close out the show with this week's Money Moment. We're back in 30 seconds.
Hi, I'm Robin Robinson. This week in other news, I'll sit in conversation and community with former Cook County State's Attorney Kim Foxx. We'll talk about her legacy, the many highs and lows from her time in office, and what you need to know about holding those currently in office accountable. Kim Foxx, in her own words. Join the conversation on CAN-TV Cable Channel 19 or stream live on cantv.org or on the CAN-TV Plus app. Hyperlocal news and critical analysis. Experience the power of community television.
The Book of Wisdom says, wealth gained hastily will dwindle, but whoever gathers little by little will increase it. In a world obsessed with getting rich quick, it's easy to be drawn in by flashy promises and social media influencers selling shortcuts to wealth. But the truth is, building a solid financial foundation takes time, and the stronger your foundation, the more secure you'll be when financial storms come. The two investment strategies we discussed today, stocks and real estate, aren't trends. They're time-tested, proven ways to grow wealth. Whether you're starting with a little or a lot, what matters most is that you start. Small, consistent steps can lead to big financial wins over time. So don't wait for the perfect moment or the perfect amount. Begin where you are. Stay the course and keep learning. Wealth isn't about luck. It's about discipline, patience, and making your money work for you. So here are your action steps from today's episode. Number 1, define your investing financial goals. Write them down and determine which investment strategy, stocks, real estate, or both, aligns with your vision for the future. When you know where you're going, it's easier to choose the right path to get there. Number 2, do your research. Learn about the different types of investments. Assess your risk tolerance and make informed decisions. Use trusted resources like investor.gov for stock market investing, or connect with a local real estate expert to understand property investment options. Number 3, make room in your budget. Investing doesn't happen by accident. It happens when you prioritize it. Set aside funds consistently to build to your investment goals, no matter how small the amount. Wealth building is a journey, and every step you take brings you closer to financial security and freedom. You've got this. Join us next week as we're back in the lab for our season finale. For the first time, we'll have a live studio audience to ask the experts, a personal finance Q&A. We will also be back with an all-new edition of Money Matters. If you have any questions about today's topic or any financial question, send them to me. Email me at tamara@moneybasicsonline.com or follow me on Instagram at IamMoneyBasics. Also follow my guests on social media. I would love to keep this conversation going, so let's connect. Remember, we are on this journey together to get, stay, and grow in the money. See you next time.